This is the Leventhal Report with Michael Hartzman and Dominic Tavella. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominic Tavella and Michael Hartzman.
All right, I'm Michael Hartzman. Today is Tuesday, June 14th, 2022, and I'm on, as always, with my partner, Dominic Tavella, coming to you also from Long Island. How are you, Dom?
Doing well, Mike. Good evening and welcome aboard. Should be an interesting show tonight.
Thank you. It's just me and you tonight. There's been so much going on in the market that we didn't book a guest. And Dom, we're going to spend the first half of the show talking about this bear market, and then we're going to spend the second half of the show talking about the histories of bear market, which I really think is super important as we kind of work our way through what's been happening recently. But like we always do, let's start off with the numbers. And it was another very ugly week in the market last week, Tom. The S&P was down 5% for the week. The NASDAQ was down 5.5% for the week. And through right now, the S&P is down about 22 and the NASDAQ's down about 31, all pretty ugly.
Yeah, Michael. So just a bear market. I get this from clients all the time. I hear that. What does it mean? It means at least a 20% correction. And the S&P had been floating with that number for a while, but finally broke through. And now we officially, last count, a little bit over 22%, maybe close to 23%. And gosh, the NASDAQ has just had a really rough time of it. So we're in a bear market, and it really all started, really culminated the end of last week with the inflation data that we were hoping would be better. But obviously, Mike, and you'll crunch out the numbers for us, but they weren't good. The number was not a good number.
You know, and you and I, as everyone knows, we talk to our clients all day long, and we both put quite a bit of stock in the number you're referring to, the Consumer Price Index, the CPI. And we were both cautiously optimistic because we were getting some hints that inflation might be rolling over, right? But
yeah,
we both...
Sorry, Mike. So just dating back 3 months ago, we had gotten a terribly high number. The month before, a high number again, but slightly lower. And not that we expected inflation was just going to disappear, but we were just hoping for a slightly lower number again. And one could argue that it came in slightly higher, but that's not the trend people wanted to see.
Right. And it's not the headline people wanted to see because you know, the headline was that this was the highest number in 40 years, which surpassed the highest number before that, which was also 40 years ago. And, you know, when the headlines are that ugly and it's a Friday afternoon, people just want to, in the summertime especially, people just want to take risk off the table. And Friday into Monday, you know, yesterday was just, I don't know, Dominic, if it was that sell-off that you know, all hands on deck, let's sell everything sell-off that sometimes we hope for, but the last 2 days and even today the market was down again, just was no one wants to take on any risk and no one's in the mood to buy anything.
Yeah, look, Mike, to your point, Friday was an ugly day, down day. But in our world, it was on light volume, and that's I think what you were trying to point out. There weren't a lot of people trading, and that usually allows the market to move up or down, you know, kind of dramatically. So don't want to use the word excuse Friday, but Monday people came back looking at their accounts over the weekend, and clearly fear had set in. Some heavy selling yesterday and a little bit of selling today. Tomorrow we get the big announcement by the Fed and what they're going to do with interest rates, and more important, what are they going to do with the bonds that they're holding. So we're clearly in a very volatile stage right now. And, you know, it's hold on for a little bit. I believe it's going to be hold on tight.
You know, and you're right. And just to finish the point about, you know, the CPI and how it ties into the Fed and why the market kind of is punishing the Fed, if you will, is when the CPI number came in hotter than people expected, the fear now, Dominic, as you know, is that the Fed still has not acted quickly enough to control inflation. So now we went from 25 basis point hike to a 0.5% certainty that tomorrow they were going to raise 0.5%. And then by Friday into Saturday, you were hearing calls from some pretty smart people who normally don't panic that, they should definitely do 75%, I'm sorry, 75 basis points, and maybe even 1%, maybe even just rip the Band-Aid off and do two of the raises they were expecting in one fell swoop. How do you feel about that?
Well, I just want to take a pause that for a second, Mike, and just kind of explain to our clients that the raising of the interest rate is a putting the brakes, tapping the brakes, putting the brakes on the economy. I saw the number today. I won't lie to you, Mike. I was a little surprised myself. A 30-year mortgage today, 6+%. This is, remember that just a couple of months ago, you could have got a 30-year mortgage in the 3 to 4% range. Now it's over 6. So when we talk about the Fed raising interest rates, some people are like, well, what does that mean to me? It means that everything becomes more expensive, and typically people stop spending money, which slows the economy down. And to your point, Mike, and this is where I want to pick it up, is that depending how much the Fed is forced to slam on the brakes to the economy, it then puts us into a recession. Right. So the fear right now is that the Fed is not going to have a choice, that inflation is not going to slow down anytime soon, and they will make a mistake. And this is the policy mistake that people like us talk about all the time. Hey, we think, we hope, we pray, but it's in their control. They slam on the brakes too hard. We're in a recession. People lose their jobs. Company profits go down, stock market goes down a lot more than it's already gone down.
So the irony of it is, we say it every week, the reason we're going through this right now is because the economy is too strong. And it's sometimes so contradictory that we go from the economy being too strong to the economy actually shrinking into negative territory for more than 6 months. And then we have that recession. But to your point, yes, the stock market will go down on that headline and will go down on that negative news. But the flip side of that, Dominic, is that doesn't mean we're suggesting that people go to cash and people run and hide, because there's still places to invest money, even in a recession, right? There's consumer staples, there's dividend paying stocks, there's energy, there's healthcare. There's plenty of places to put money. It's just you have to be more selective during a recession.
Absolutely, Mike. And we're going to spend a lot of time on that, I think, later on in the show. And I don't want to steal the thunder from later on, but the S&P was down 10% in a week. It was impossible to time that. I thought we had taken a pretty defensive posture in our portfolios. And I guess if you look at the net results, we did, but who expected a 10% down, I won't say week, and you could equally have a 10% up day week if things were to play right. So this idea that you can time it, you can, I'm going to take the money out, I'll put it back in, I'll put it in, take it out, is near impossible. And if you get it right once, you're sure not going to get it right twice, meaning get in, get out, a round trip. So from our perspective, we really want to look at the symptoms out there, and then try to understand what can we do to help our clients through this process, and how do we actively rebalance these portfolios to give us as much protection, but don't make that big bet in or out trying to time the market.
Right. 100%. And to your point, the NASDAQ has been in a bear market for probably most of the year, right? I mean, the NASDAQ went down pretty hard in the beginning of the year. And the reason it did, you mentioned homeowners and people who need a 30-year mortgage. But the reason the NASDAQ went down so hard in the beginning of the year is they're typically smaller, not as well capitalized companies who rely on lines of credit, who rely on private equity and borrowing money. And even then, if interest rates went from 2 to 3, let alone 5 to 6, the cost of them doing business got materially more expensive. So we've been seeing this domino effect for quite a while with these rising interest rates.
Exactly right, Mike. Exactly right. I mean, we literally can go to January 1st of this year, but you can go back into the third, fourth quarter of last year. We call it risk on, risk off. And if you look at well-capitalized companies, companies that have good earnings, companies that have good, strong balance sheets, yeah, they've gotten beat up a little bit, but overall, not terrible. But if you look at the more speculative, we can call it aggressive, but I certainly would call it more speculative part of the investment arena, these small, aggressive tech stocks have just 22% on the S&P and 30% on the NASDAQ is bad enough. But some of these stocks, Mike, are down 60, 90%. And you're never getting your money back. The first one I've heard, but I think it's going to continue, one of these SPACs. You remember the word SPAC, Mike? Our clients calling up, what's a SPAC? We should own them. Filing for bankruptcy. This thing came public less than a year ago. Today it's filing for bankruptcy. I don't know how many of these SPACs are literally going to disappear completely within the next 12 months. So the more speculative, aggressive companies didn't have strong balance sheets, didn't make stuff, didn't sell stuff, certainly didn't have profits. These companies have gotten destroyed. They've gotten decimated.
Yeah. And for anyone who's curious, wants to Google it, it's SPAC. It stands for Special Purpose Acquisition Corporation. And we're not going to get into details of it. You can look it up. But Dominic, you're right. They are definitely more speculative investments. So getting back to the mundane questions and the real questions that we get from clients, is several clients have said to me, well, is this going to be the 80s? Are we going to go back to 15, 16, 17% interest rates? Because we keep hearing that interest rates are rising quicker than expected. The difference between then and now is now the Federal Reserve, Dominic, as you know, we're starting from zero. So Paul Volcker and his Federal Reserve in the 80s, when they started raising interest rates, they were not starting from zero. So what people have to remember is this Federal Reserve has a much, much longer runway to raise interest rates, and the likelihood, I would venture, of interest rates even getting close to even 10 is very, very, very remote.
Look, I couldn't agree with you more. Let's start with that. But what is causing this, right? And God knows, all of us go and fill up our cars, and that's an easy answer, right? The cost of energy has skyrocketed. And we could spend some time later on of how and why that's going on. But the cost of food, we still have supply chain issues where product not coming in from China as fast as we need it. So there are things that are causing inflation to get worse. But every one of them, I think we can look at and say at some point down the road, and hopefully sooner than later, but at some point, these things will resolve themselves and inflation should start to come down, right? The employment numbers are very solid. Job growth is very solid. Open jobs, plenty of them. I think the last count we had over 11 million jobs. So it's not that the economy is in really terrible shape, right? The amount of debt that consumers, it's rising, but it's not terrible. The amount of debt that corporations have is not terrible, right? So a lot of things that could cause a lot of headaches and problems for a much longer period don't seem to be there. So we could see where this thing does start to roll over, but it's going to take time, Mike. And I think the volatility persists for a little while.
Oh my God, the volatility is going to persist, in my opinion, until we get clear-cut evidence of what you just said, that inflation is rolling over, that the Fed has got a handle on this problem, right? And the argument could be made, that if the Fed does, and I don't think they will go 100 basis points tomorrow or 1%. I think that'd be a little bit out of character for them and a little bit aggressive. But Dominic, immediately if they do that, then there will be speculation that the Feds have slammed on the brakes too hard, and this recession people are expecting in 2023 now magically becomes a 2022 story.
Yeah. And Mike, I want to say this out loud, and I'm kind of reluctant to say it out loud because anybody, and we see talking heads on TV all the time, and I won't point the finger at you or me, but, we know we're going to have a recession on this date, or we know we're definitely not going to have a recession. Look, and I'm guilty of it as well. Where you can at least look out into the near term and go, it's not likely we're going to have a recession. And then you can look out and say, if the earliest we could see one might be the second quarter of next year, or maybe the first quarter of next year. And we're all kind of predicting. So I don't want to be one of those bobbleheads in a box here. But the likelihood of a recession in the short run, I think we're okay. But predicting one in the longer term or 6 months out, it's impossible. It all depends how hard the Fed is going to slam on the brakes. And we keep coming back to raising interest rates. And if you could tell me that's what's going to happen, I can tell you with almost certainty when we're going to get a recession. But nobody knows how hard the Fed is going to come down on the economy. Nobody knows. We're all guessing.
Yeah, and the problem, Dom, now is that the market, both the stock and bond market, and this is the other challenge that we've had this year in managing clients' assets, is the bond market has been just as miserable as the stock market, which is not supposed to happen normally. But both the stock and bond market has lost faith in the Fed that they could fight inflation fast enough, which is why, quite frankly, I think the market sold off after that number, because it reiterated the market's lack of faith in Jerome Powell and his Fed staff.
And I agree with you, Mike, on that statement, but I would add that this guessing that they may be in a position where they just have to raise interest rates more aggressively. And the more aggressively they raise interest rates, the more likelihood we go into a recession. So we're all guessing, Mike. And, I think both of us can be cautiously optimistic that we'll start seeing the light at the end of the tunnel. The tunnel might be a long one, but at least we could start seeing the light over the next couple of months, i.e. inflation starts peaking out and then eventually starts to roll down. But if we don't get that good news over the next couple of months, then the Fed just continues its policy. It'll have no choice. And then, you can write in a recession into our projections probably early next year.
And then I know we're going to talk about the history of the market and the history of bear markets. I apologize on the second segment, but this kind of ties into, Dominic, a lot of money for our clients that we don't manage. Right. So because we're actively managing clients' portfolios, but we're not allowed to, for the most part, actively manage our 401ks unless obviously we install them. And this is the time where a lot of people normally do not pay attention to their 401ks, turn on the news, and decide in the spur of the moment that they're getting out of the market. Right. And they may look like a genius in the short run, but as you said, no one knows for sure, and no one certainly knows for sure when to get back in. And this is the time where, clients also should not overreact and do something, especially with their retirement accounts, that they may regret down the road.
Yeah, look, Mike, I'm glad you brought that subject up. I didn't think of it, so I'm grateful for you bringing that subject up. At the very least, hopefully it's our client, but pick up the phone, reach out to your financial advisor. Hey, can you do me a favor? I know you and I do it all the time.
All the time.
It's not even asking for a favor, but for our clients. But reach out to your advisor. And I just reviewed a new client portfolio. And ironically, I thought the prior advisor had done a relatively good job of managing the account that they had, but they had given them zero advice on the client's 401k. And so the client's 401k had done substantially worse. And my point is, reach out to your financial advisor, reach out to us, reach out to our staff, ask for help. We can guide you. We can give you some advice on rebalancing those accounts, but do not make that panic move. I'm going to get completely out of them. I mean, if I'm retiring next week, that's a different story. But assuming you're going to be working for a considerable period of time, usually the bailing out at the bottom of the market is not a good strategy. That usually doesn't work. And if you guess right to get out, what are the odds, Mike? I'll throw it on at you, but what are the odds to guess right to get back in?
Slim and none, right? The odds are slim and none. But here's the other part of it, Dom. Not only do you have the time when to get back in, again, if you don't pay attention to this every single day like we do, everyone learned in Economics 101, when the stock market goes up, the bond market goes down and vice versa. So now, if you're just a typical investor and you're looking at the choices in the 401k platform, go, oh, this says bonds. I remember that when stocks are crappy, the bonds do well. So I'm going to move my money into the bond market. And if you do that, you are really in for some sticker shock, because as we said earlier, they have not been a bargain either.
Mike, I know you already heard the number, so I'm going to look down at my cheat sheet. If you had bought January 1st of this year, a 10-year treasury, that's a U.S. government bond, guaranteed, AAA rated, today, the value of your principal is down 13%. 13%. So people were typically buying something for safety. Oh, I can't possibly do anything wrong. The value of your account is down 13%. Now, 10 years from now, it'll mature at your principal, but you're waiting a decade to get your principal and interest back. And again, there'll be volatility in the meantime. We'll see what happens. But here, you thought you were buying something for safety's sake. It didn't really work out that way.
Right. Right. And although you don't buy municipals typically in a 401k, the municipal bond market's been just as challenging and just as miserable.
Yeah, it's been been a rough year, as many of the experts have said, and we're repeating. There's been very few places to hide this year, and your typical 60-40 portfolio, 60% in the stock market, 40% in the bond market, really has not worked out very, very well at all. In fact, you have almost S&P type performance negative on a year-to-date basis, where you normally would have had some safety built into that portfolio. So it's been a rough year, and I think hopefully what we try to do tonight, and what we've tried to do all year, is to go, you know what, look at this in a long-term, look at it over a 5 or 10 or 20-year period. Don't try to focus on the day-to-day volatility. Don't make decisions emotionally. They'll tend to be wrong. Even if you're right in the short run, they'll tend to be wrong in the long run.
I'm glad you mentioned that, where do you put money, and there's been no place to hide, because I'm looking at my cheat sheet, and the energy sector, and I don't remember any year where it's been this distorted. The energy sector, Dominic, through last week is up 61.7%. 61%. Now, granted, 2 years ago, the energy sector was annihilated, right? Because everyone was home, no one was driving. The energy sector was dead last.
People forget that oil at one point, I'll say, was under $20 a barrel, but in some cases, producers were paying people to take oil because they had no place to store it.
Exactly.
Right. So everybody wants to beat up the big oil companies today for making profits, but people forget just 2 years ago, they were losing their shirts because no one was using oil, right?
Exactly.
No one was driving.
Which was the argument, you shouldn't have sold all your energy investments then, and you don't sell everything now to go into energy, because again, this too shall change. But the next leading sector is utilities, which is up 0.4%. So less than 0.5%. And then the third leading sector, which is a sector I love in a recession, is consumer staples. And the third leading sector is only down 6.5, right? And then it's followed by materials and healthcare. But again, Dominic, if you think about it, if we're heading into a recession, these are the sectors that will continue to kind of be recession proof, if you will, or bulletproof. Because like you and I have said in our last previous shows, and even in a slowing market, people are still going to the supermarket, they're still going to CVS, they're still buying the basic necessities that they need, even if they're down to their last $100.
Yeah, they're going to do it, Mike. And then human nature, I want to sell what's not working. And we can talk about energy 2 years ago. And I want to buy what is working. And you look how much energy has gone up this year. But trees don't grow, to the moon and the stars, right? At some point they cap out. And so the client's like, well, we should own more energy. And of course we do in our portfolios. But maybe sell high and buy low. People forget that. Sell high and buy low. And you would have wanted to sell technology 2 years ago because it did amazingly well, the Netflix of the world and some of these other stocks that have just gotten destroyed so far this year. And maybe buy energy when it's all beat up, right? And today, maybe sell some energy to buy things that have gotten beat up, right? This rebalancing of your portfolio to sell high and buy low. So you got to do it unemotionally. This cannot be emotional decisions.
Right. And yeah, and to your point, you would think that technology was the worst sector, but it's actually not. It's the third worst sector. The second worst sector is communication services. And the last sector, which is the worst, down almost 30%, which makes perfect sense, is consumer discretionary. So what does that mean? That means the big screen TVs. That means the cruises or the vacations. That means the new driver you were thinking about getting if you're a golfer. Maybe you're not spending $500 at the PGA store. You go, oh, my driver's fine for another season. So that's a discretionary sector that has gotten clobbered. And again, if you think about it logically, Dominic, doesn't that make perfect sense?
Yeah, and look, I don't expect that our clients do this, but it's our job to do it. I believe the symbol is XLY, the ETF for consumer discretionary. Well, its largest holding is Tesla. Now, I don't understand why Tesla is in the consumer discretionary bucket, but I don't get that. I don't make that call. But because it is, that sector and Tesla stock has just gotten decimated. I don't know what it is year to date, but it's gotten decimated. That particular sector has really taken it hard. It's really gotten beat up pretty hard. So I think Nike might also be in that bucket, Mike. So there's been a few stocks that really, as a sector, have destroyed, has significant damage to that ETF, that particular bucket.
Yeah. So look, we're just about out of time on this segment, Dominic. So I think, we spent a decent amount of time talking about this bear market. And then when we come back, we want to talk about the history of other bear markets, just to give our clients, maybe a little Xanax, a little Lexapro, kind of take the edge off, maybe a stiff drink, just to take the edge off of what their fear might be right now.
And Mike, and again, I know we're running out of time, but look, this is hard to look at. Looking at your statements, it's not easy. We're not discounting that, right, Mike? We're not being flippant about it. What we're saying is, let's have a reality check, right? Let's look at what it is that's in your portfolio. Let's look at what's really going on out there, and then make a common sense, hopefully unemotional decision.
Good advice, and we will be right back after
Now,
this break.
back to the Leventhal Report.
All right, I'm Michael Hartzman, back with my partner, Dominic Tavella. And Dominic, I know a podcast is audio medium, but I shared my screen this evening, and a lot of our folks do listen and watch the podcast on YouTube, and we do get it out to them in an email. And I thought it was important to share our screen tonight, because we got a great link from Hartford Investors talking about other bear markets. And the headline, Dom, as you could see, is avoid costly, panic-driven investment decisions during a crisis and remain focused on the long term. And then, they show these red buttons of markets in the past that have gone down 30%. And they go back as far as 1968, when interest rates rose above 9%, and we're in the middle of the Vietnam War, and the market went down 36% over a year and a half period. And then during the oil embargo in the early 70s, it went down 48.2%. And then the stock market crashed right around the time you and I got into the business.
I was gonna say, Mike, that was my first one, still scarred for life.
Yep, I remember the day well in August. Really, October was that one dramatic, what they call a Black Monday or
Friday
something.
and then Monday.
Yeah. So that was down 33.5. And then we all remember the dot-com bubble down 36.8. WorldCom collapse, Tyco executive indicted, Ford closes 5 plants, a bombardment of bad news, and over a 9-month period, the market went down 33.8% in 2002. And then the financial crisis, we all remember, that was a doozy. From 2007 to March of 2009, it went down 56.8%. And then the one we just got out of, Dominic, global pandemic, the market was down in a 2-month period, believe it or not, 33.9%. So that's what's interesting to me, Dominic. The first one between November 29th of 1968 and May 26, 1970, almost a year and a half, the market went down 36.1%. And then this time in what, 5 weeks, it did the same thing.
Mike, and look, we're looking at the 30+% ones. God knows how many 20+% ones were in
too many.
the middle of those.
Too many to list.
And, again, you and I, both having gotten into the industry in the early 80s, I think we could still probably rattle every one of these off. But, I find it surprising. Clients like, well, we haven't had something like this bad in a really long time. I'm like, March of 2020. That was just 2 years ago. And this is the S&P at 33.9, but the NASDAQ, I think, was over 40%. So I call it a 35-40% on the average correction. That was just 2 years ago. 2 years ago. And again, we know why. The world, not just the US, the world economy was completely shut down. It's logical that markets would react in a very negative way. And then once it looked like that some kind of vaccine would come in and the economies would reopen up, the markets recovered. So we're looking at a 22-3% right now for the S&P. It might get worse before it gets better, based on this idea that inflation will not subside really quick. But if you had sold out of your portfolio at any one of these moments, Mike, any one of those, when would you have gotten back in?
You don't, Dom. You don't get back in. I still have clients waiting to get back in from the financial crisis 13 years ago.
Mike, a stat I know I've used many a times, in the last crisis 2 years ago, 35% of people over the age of 65 got completely out of the market, and they got out at the bottom. They didn't get out after full recovery of their portfolios. They got out at the bottom. Well, have they even gotten back in, Mike? And many of them have not.
Right.
Many of them not.
And you and I, from time to time, talk about headline risk, and you and I try to, when it's appropriate, we could always lean on the media a little heavy, but Hartford gave us a statistic, which I personally have never seen before. Maybe you have. Let me just read this paragraph, which I think is very telling. When a crisis hits, news ratings surge. For example, in the early days of the global pandemic, from March 16th to 20th in 2020, Fox News saw its ratings climb 89% over the same time last year, while CNN was up 193%, and MSNBC was up 56%. So, it is the old axiom that if it bleeds, it leads. And when, as I said earlier in the first segment, people come home, they flip on the news, they've been doing their day job all day, they haven't been paying attention, and they see these headlines and they interview the man on the street and they make a spontaneous decision. Oh my God, I'm going to get out because it's never getting better.
And Mike, we just kind of spent a little time going in the timeline over these last 5 days. But when you get home from work on a Friday, whatever you do, you're a fireman, you're a cop, you're a doctor, and you turn on the news and it says the stock market plunged, right? Plunged.
Right.
You really want to look at your portfolio? And if you do you really want to go for that roller coaster ride? Do you blame the fact that people make emotional decisions?
Absolutely. I mean, Tom, we had that guest on a couple of weeks ago, and he said if the buttons on the elevator said plunge and soar, no one would get into an elevator, right?
I don't blame people for making decisions when they've watched their life savings go through these roller coaster ride. I think what we're both asking people to do is pause, take a moment. What is it that we're trying to do? Over what time frame are we trying to do it? And if you need the money next week, I get it. Do what you got to do. But if you're looking at somebody who's in their 40s and they're going to retire 20 years from now, we can go back to your prior chart, Mike. These things, unfortunately, but they happen. Life interferes. We get periods of time where something frightens the markets, frightens businesses, frightens consumers, frightens economies, and we need time to recover. And we usually and historically do.
Dom, this next chart is super important. It's super telling. Again, this is one you and I have both seen many, many, many times. This chart's called the price of panic. And they display a $10,000 investment in the S&P 500 that began on December 31st, 1959, and went all the way through the end of last year, December 31st, 2021. And they include the market drops along the way. Every market drop I described is on this chart. And to your point about the cash investor and staying fully invested, if you invested your money in cash over that period, that $10,000 today would be worth $142,000, $142,030 to be exact. Not terrible. If you were the reactionary investor, someone who got in and out and tried to time the market, Dominic, but you were in the market for periods over that time, you would have $550,194 over those 61 years. The bond investor would have $834,536. These are really telling. The balanced investor, Dominic, would have $2,520,076. And the person who kept all of their $10,000 invested over the last 61 years and just let it ride and let it go through those crises we've outlined would have $4,973,667, Dominic.
And I think this is where we're going to go next, Mike. It's the emotional fortitude to understand what it is that you actually own, to understand where your monies are. And I know I've gone through it quite a few times recently with my clients. I think you do as well. People are like, well, I own the S&P 500. And that's such a kind of ambiguous statement, right? Mm-hmm. It's just an index. But when you start breaking it down, what is it that I actually own? Most people are like, well, those are good companies. Those companies are not going to go out of business. Those companies are probably going to be around 5, 10, 20 years from now. They're just going through a business cycle, right? So again, this common sense conversation versus an emotional conversation.
Yeah. And Dom, let's go through some of those names. And obviously, we're not going to go through all 500, and neither one of us know all 500, but we mentioned a couple on the break. What'd you say? There was Johnson and Johnson
Yeah,
and
so I brought it up, Mike, while we were on the break. It's one of the ETFs that we own in our client portfolios. The symbol is QUAL, Qual, standing for quality. These are supposed to be some of the best companies in the United States. And I'm just going to rattle off the top 10 holdings. So if you own Qual, you literally own Johnson and Johnson. You
Mhm.
own Nike, you own Apple, you own Meta, the old Facebook, Microsoft, Costco, MasterCard, NVIDIA, Eli Lilly, Alphabet, Google. Those are
Mhm.
just the top 10 holdings and probably another 50 or so companies like it. When I rattle off those names to my clients and say, well, this is what you actually own. And I
Mhm.
realize that most of those companies are selling at a 20, 30, 40% discount to where they were 6 months ago. Do you want me to sell them? And they're like, no, I want you to buy more. They're on
Mhm.
sale, right? And that investor that you showed in the prior chart, Mike, that ended up with $4 million in the bucket was reinvesting their dividends
Mhm.
and buying more shares. So when those shares went down in value, and some would argue were on sale, but went down in value because of some economic cycle that we were going through, they were buying more shares of those companies at a discounted price. And that's what that compounding effect is that could allow a relatively small amount of money, $10,000, turn out to be worth $4 million.
Almost 5 million. Almost
Yeah,
5
that
million.
many years later.
Yeah, 4.9 million.
Amazing, just
Yeah.
amazing.
You know, our business loves axioms, right? And one of its favorite, I think it goes this way, it's not timing the market, it's time in the market.
Time in the market. And again, I want to emphasize this ability to compound and buy more shares. Typically, it's dividends that the companies are paying out. But if you're in a 401k plan, Mike, and you're adding every single paycheck every week or 2 weeks or how often you get paid, and you're taking money out of your paycheck and you're buying more shares, don't get excited out there, but you should get giddy when the market is down. If you are accumulating more shares on a regular basis, either monthly dollar cost averaging into an account or a retirement plan where you're adding every paycheck, you should be getting excited that you get to buy stuff at a 20 or 30% discount.
Dom, I know we both know how to do it. I know we both talk about it. Why don't you explain to our clients and our audience what exactly dollar cost averaging is?
So dollar cost averaging is that you are typically systematic, hopefully systematic. You are buying on a regular dollar amount on a regular basis. So it could be once a month, once a paycheck, but you are buying into whether it's an individual stock or an index in the market or a portfolio, you are buying systematically on a regular basis. You're not really paying attention whether the stock market is high, the stock market is low. So sometimes you are buying because the market's performing very well. Let's talk about a year ago. You are buying when the market is high, but when the market is going through one of these corrections, like we're going right now, you're also buying low. And what that creates is an average price over a long period of time where you didn't buy at the top, you didn't buy at the bottom, you bought at an average price, but ends up being substantially lower than the end price, which you showed on your chart, Mark, right, where that client almost had $5 million. So the advantage of this market volatility is to the investor that is buying on a regular basis.
Right. So if you're putting away $100 every week and you're buying a stock that costs $100, you obviously get one share. But guess what? If that price of the stock goes to $50, now you're getting 2 shares, right? You're getting twice as many shares when you're buying on the way down. And the analogy that I always give my clients, if you're in the supermarket and your favorite coffee is 50% off or buy one, get one free, you don't say, I'm not going to do that. They must have put, the crappy coffee in there. Of course you buy as many of those cans of coffee as you can.
And I'm just going to put one caveat, and that's quality, right? When you're talking about the advantages of doing this, clearly when you're buying the S&P 500, you're buying all 500, and that index changes over time. So you're kind of safe. But if you're trying to do this with with lower quality companies, sometimes they don't recover. We all remember the garbage.com era where some of these companies disappeared off the face of the earth. But some of the names we just rattled off, Mike, and we're not making judgment calls on individual stocks, but good quality companies, good strong balance sheet, good earnings, good dividends. Over time, they tend to do pretty well.
And on that note, we're going to take a quick break, Dominic, and we'll be back to wrap it up.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with Dominic Tavella. Try to put a bow on the last hour. And before we get into the last point we want to make, Dominic, I just want to make clear to our audience and to our clients, the information that we share tonight is available for us to email to you. If you'd like it, just contact either myself or Dom or our offices, and we'd be happy to email this report that we got from Hartford investors. And to that point, Dominic, I mentioned earlier, it's not timing the market, it's time in the market. And the last bullet point we want to go over is how the markets have performed by holding steady versus trying to time the market and get in and out. And the chart calls it the average equity investor. But really what they're saying is someone who trying to outsmart the S&P 500.
Yeah, I think, Mike, and you and I both get it. So I don't want to say it's just me, but the client says, let's get out. And then when things get better, we'll get back in. And so let me see if I get this right. We'll get out now that things are terrible, meaning the market is down or way down, and we'll get back in when the market recovers. We will sell low and buy high, right? And it's, when you explain it logically to people, they go, well, that's kind of silly, right? But this chart that you have here, Mike, literally says that if you just held on and just went through the roller coaster ride over the last 30 years, the S&P would have been over 10% a year. But the average investor, equity investor, made only about 7% a year. And that's that person like, I'll get out and I'll get back in when things calm down. You're literally selling low and buying back in at a higher price. It might make you feel better, but it sure affects your total return, how much money you make on your portfolio.
Yeah, and those clients who could see this along with us, Dominic, these are average annual returns. This is not the 30-year return. This is the average annual return. So if you give up 3.5% a year for 30 years, that's a big number.
And that's back to that other chart, Mike, where the person who was all in was close to $5 million in assets, but that other person, maybe half that number if you were lucky, or dramatically less. And I think these numbers in themselves even can be a little, they're probably not as dramatic, because I've seen numbers that are far worse in some of these very popular mutual funds where the fund over time has done incredibly well, but the average investor's made a fraction, because people love these investments when things are going great and they hate them when things go awry, like they're doing right now, and they get out, right? So we can beat this horse to death, but it comes down to try not to make these decisions emotionally and really reach out to, obviously our clients reach out to us and let us help you make these decisions. Maybe we have a more prudent way to approach this and tamp down some of your risk and some of the emotional part of this that makes you not sleep at night.
Dominic, another expression that's been drilled in our heads since we've been in the business is past performance is not a promise of future results. So neither one of us could sit here tonight and say we guarantee you that this is going to happen. But what we know, and again, believe me, Hartford would not be printing these things and distributing them if they knew that our regulators were going to come and slap them on the wrist. All we're trying to do tonight is provide some history, provide some perspective. Not that what we're going through isn't serious, but we will get through this one also.
Yeah, Mike, and if it's one thing, I think your charts, I thought they were terrific, by the way, really showed is that, this time it's different. No, it's not.
Right.
No, it's not. I mean, the excuse is different, right? The reason why it happens is different. Every one of those past 30+% corrections had its own unique set of facts why it caused a market correction. So the reason might be different, but the reaction was very, very predictable. And then I'm sorry to say, although I can't guarantee anything, I'll bet you it happens again over the next 10, 20 years, Mike. I can't guarantee that it will, but these corrections do happen. But I think what we're both comfortable in is that the US economy and US companies are good at fixing it, recovering it, putting it back in place, and then we grow out of it. Right.
Absolutely.
So no guarantees, Mike, but we have a pretty good history of doing it as a country. And I do believe in that. I do believe that US companies and the US consumer who needs to spend money, will revert to fixing it, and things do recover.
On that note, Dominic, we are out of time, my friend.
Unbelievably, Mike, but one more in the books.
See you next week.
Have a great night.